Good afternoon, ladies and gentlemen. Welcome back to this week, 24th March weekly market review. As usual, I have with me Mr. Gerald Wong today. How are you, Gerald?
Hi, Sunny. Very well. We are now almost towards the end of March. I think I have seen a lot of questions around what to do with the volatility in the market. So even though we are just in the first quarter of the year, we have seen a lot of developments in the global markets, in the US, in China, and in Singapore as well. So hopefully from today's weekly market review, we can provide some of these updates for you to be able to make a better financial decision.
Yes, indeed. We have also just finished the March school holidays, and now the kids are back in school. So I got a bit more time to look at the market. Last week, we have an update from the Fed to see how the economy is doing and what is their projection on the inflation, which I think is not too bad, and Gerald will go through in details. And on the Singapore side, we also had a 2.38% gain last week on the STI, which more or less covered more than the previous week losses of 2%. And we are now back above the 3,900 point level and within striking distance of STI all-time high again. So I think I'll let Gerald take you through some of the details first. Over to you, Gerald.
Thank you, Sunny. First and foremost, today's sharing is for informational purposes only and should not be taken to be financial advice. Okay, if you find the weekly market review helpful, do leave us a review on Google. And if you're wondering how you can join SIAS as a member, you can go to this QR code or the website sias.org.sg/membership. And as a SIAS member, you can access various online resources as well as investor education programs. Okay, so the good news for stock investors is that we saw a slight rebound in the market last week. The S&P 500 edged up slightly by 0.5% to the 5,668 level. And then for investors who are vested in the Singapore market, we saw the STI going back up above the 3,900 levels once again, with a 2.3% gain in the past week. Okay, I think if you follow our weekly market review, what we shared in the previous week is that the key thing to keep a lookout for is the Federal Reserve meeting. So as expected, the Fed kept the interest rate unchanged. We are now at the target rate of 4.25 to 4.5%. Okay, so that is widely expected, and the Fed also kept its forecast for 2 potential rate cuts in 2025. But I think what investors were also looking out for were some of the comments by the Fed. And here what they noted is that there's increased uncertainty in the economic outlook. And we see that being reflected in their inflation as well as economic growth forecast as well. Okay, so currently, if I were to look at investor expectations for rate cuts, this is based on the CME Fed Watch tool. In the upcoming meeting in May, investors still widely expect that we will see the target rate maintained at 4.25 to 4.5%. But going into the June meeting, we might see one rate cut then, and then potentially another one in September, and then maybe one additional one in December this year. Okay, so while the Fed is actually forecasting 2 rate cuts in 2025, what we see that the investors are pricing in would actually be already 3 rate cuts this year. Okay, but what we do see is a lot of uncertainty towards the interest rate direction, which is why the global bond yields have been very volatile. We see here the US 10-year government bond yield, and it has actually come down from the peak earlier this year. But still, we see that it has been moving around quite a bit over the past few weeks as investors try to digest a few different things, including Trump's tariff measure, the latest inflation data, as well as the latest employment data. Okay, so how has that translated to the Singapore market? We noted earlier that the STI had a 2+% gain. And if you were to look at the top gainers, Yangtze Shipbuilding, Semcom Industries, as well as NCT Engineering, all of them with more than 6% gain. Okay, if I were to look at the worst performers, we have here a number of the Jardine-related names, and that is largely because they went ex-dividend in the past week. So this is reflecting the dividends that were paid out. Okay, so one of the questions that we commonly get is, given the expectations of the Fed rate cuts, what is this going to do for the Singapore banks, given that they had already a very strong performance in the past year? Okay, so if you look at the past 12 months performance, the STI was up by 22%, a very strong performance. But if you were to look at the banks, DBS was up by close to 40%, UOB close to 30%, and OCBC more than 30% gain as well. Sorry, we saw DBS having a close to 40% gain, UOB close to 30%, and OCBC above 20% gain as well. Okay, so effectively, they have outperformed the STI, and the question is, would they be impacted by the potential rate cuts? Okay, so this is an example. We saw DBS share price from about $32 in April last year, has gone up to $45, and at one point actually exceeding $46 per share. Okay, so I'll just do a quick recap around their latest results and do a comparison across the different names. So across all three banks, we saw record net profit in 2024. DBS was the one that saw the strongest growth in its net profit, up by 11%. But both UOB and OCBC saw growth in their profit as well. Okay, a big part of the growth was driven by the non-interest income. So we saw double-digit gains for the non-interest income across all three banks. And then what we saw being slightly weaker was the net interest income. DBS still saw some growth in the net interest income, but then we saw that it was flat for the other two banks. Okay, so first and foremost, if you look at the loan growth, they saw single-digit loan growth in 2024. Okay, but that has effectively moderated towards the fourth quarter of the year, where we only saw about a 1% loan growth for UOB, up to a 5% loan growth for OCBC. Okay, I think this is the chart that many investors are looking out for, which is the bank's net interest margin, reflecting the margin that they are able to make on their loan book. Okay, so given the fall in interest rates, the concern is that the net interest margin will be under pressure. And we see that in terms of OCBC's net interest margin, which has declined from fourth quarter of 2023 at about 2.29% to 2.15% in the fourth quarter of 2024. Okay, on the other hand, DBS has been able to keep their net interest margin fairly stable, 2.13% in fourth quarter 2023, and then at 2.15% in fourth quarter of 2024. So that explains why DBS has still been able to grow their net interest income for the full year of 2024. And then for UOB, pretty much flat from 2.02% in fourth quarter 2023 to 2% in fourth quarter 2024. Okay, so overall, we see that the net interest income as a percentage of total income has actually gone up for some of these banks. And we are going to look at something which is the asset under management for the Singapore banks. Effectively, this is reflecting the growth in their wealth-related fee income, where effectively they've been able to get a higher asset under management, whether is it through their private bank or through retail customers. And that has actually helped them to offset some of the pressure on the net interest margin. Okay, so the other key thing that many investors are interested in would be the capital management strategy and what are the dividend payout by the different banks. So what we see here is that all three banks actually have announced some additional dividend payout to investors, as well as a potential share buyback program. Okay, so just to summarize here, for DBS, the fourth quarter dividend per share was raised to 60 cents. They announced a quarterly capital return dividend of 15 cents per share in 2025. At the same time, a 3 billion share buyback program. Okay, for UOB, total ordinary dividend of 180 in 2024, special dividend of 50 cents in 2025, as well as a 2 billion share buyback program. Okay, and last but not least, OCBC total ordinary dividend per share of 85 cents in 2024, special dividend per share of 16 cents, as well as a 2.5 billion capital return over 2 years. Okay, so we see that being reflected in DBS's dividend per share. I mentioned earlier that the fourth quarter dividend was raised to 60 cents. So that will bring the total dividend in 2024 to $2.22, which is a sharp increase from where it was in 2022 as well as 2023. Okay, UOB total dividend of 180, and we see that as an increase in terms of both the interim as well as the final dividend being paid out for UOB. Okay, and then last but not least for OCBC, if I were to look at the interim and final dividend, effectively that would be based on a 50% payout ratio and amounting to 85 cents per share. But the company has announced a special dividend of 16 cents per share, and that will bring the total payout ratio to 60%, with a total dividend per share of $1.01. Okay, so we do see the increase in dividends announced by the Singapore banks. They have also committed to additional dividends, whether is it through the capital return dividend for DBS or through the special dividend for UOB and OCBC. So all of this is helping to boost the potential dividend payout for the Singapore banks. And based on what has been announced, and if they are able to keep to their targets, then what we see is potentially a dividend of 5.9% and above for the Singapore banks. Okay, so that is a quick recap of the performance of the Singapore banks. If you are thinking about how the interest rate changes would impact them and what that would mean for the dividend, hopefully that would provide some kind of information for you to think about it. Okay, in terms of the coming week, we have the SSB application closing date. Since we are coming to the end of the month, we also have a 6-month T-bill auction. So those are some of the key things that I will be looking out for, especially if I'm looking at relatively safe products to be parking my spare cash. Okay, so with that, I'll be handing over to Sunny, who will provide more of the technical analysis.
Okay, thanks, Gerald, for the updates on the Singapore market, especially the Singapore banks, which a lot of you are concerned about with the latest Fed updates that they see. They still see 2 rate cuts in the year ahead, okay, until end of the year. But the FOMC or the CME Fed Watch Tools is Fed Fund Futures pricing is pricing in 3 rate cuts by December. So what happened in the US market was, of course, the US Fed meeting was the center of attention. The US Fed chair announced that inflation concern is rising, but then it's likely going to be transitory. So it's not too much of a concern. That's more or less give markets some sort of a confidence because it is seen that the Fed is still in control and inflation will not cause the Fed to raise interest rates further. Okay. So everything is still in control within what the Fed projection is, so not too much of a concern. And also we hear from the latest from Donald Trump is that he mentioned that there could be some flexibility in the tariffs, but the 2nd of April tariff deadline will still be reciprocal for the other countries that have some kind of a tariffs on US goods. So it is sending some kind of a mixed message to the market, but at least he is not doubling down on the tariff threat. So I think that more or less give markets further confidence as well. But some of the companies that have the business update, including FedEx and Nike, cited the uncertainty in tariffs as well as consumer confidence coming down, impacting their forecasts or their sales this quarter. Okay, so overall, I think the market, the three major US indices saw the first positive winning week in about more than a month's time. Okay, it's the first winning week for the Dow Jones Index in 3. So you can see that the Dow Jones Index last week, we projected that the Dow Jones Index likely will rebound back to this shaded area that I have highlighted over here. So I'll just adjust this a little bit so that you can see where the candlesticks are right now. So we have sort of tested the 200 days moving average 2 weeks before. Last week, we were around this region over here. We had a bounce last week on last Friday, and Monday, we started to see that the index also starts to trend up. Okay, so this was measured according to the MACD indicator that shows that the downward momentum that we have been experiencing in the past 4 or 5 weeks is actually subsiding already. And last Friday, we have that confirmation of the MACD line cross over the signal line, signaling that, hey, now the technical rebound has been confirmed by the MACD indicator with a crossover, and we're likely going to be trending upwards towards the next resistance level, which we identify as the 100 days and the 50 days moving average, now around the 43,000 level, 43,400 level, okay, which is where the 50 days and 100 days moving average is right now. So maintaining my projection, the Dow Jones Index is likely going to move into this area with using the 200 days moving average as a support, now at 42,000 handle. That will be the key level to watch. I hope we can break or stay above the 42,000 handle this week. And we will be kept at the upper bound around the 43,400 levels, which is the 50 days and the 100 days moving average. Okay, so on the RSI, we also saw that the RSI breached the 30-point oversold mark 2 weeks ago. And then last week, we had a convincing rebounds of that 30-point mark, and also broke above the 14 days RSI moving average of 36. So the RSI is now at 42. We are about 8.7 points away from the 50-point neutral mark. And if we have crossed over that 50-point neutral mark on the RSI, that gives another confirmation to the MACD indicator that, hey, the uptrend likely have some legs and will likely push up further in what I call now for the moment as a technical rebound, okay, until we see next week to see whether when we test the 100 days moving average, what was the behavior, would the momentum and the strength push forward, okay, up further towards the upper bound of the Bollinger Band at 44,000 level, okay. So that's my take on the Dow Jones Index. So we are in a technical rebound right now as indicated on the MACD indicator, and RSI crossing above the 50-point neutral mark will confirm that technical rebounds still have some momentum to go back up further. Next, let's move to the broader S&P 500 index. Same thing. The projection is that we were likely going to stay above the 200 days moving average. So I'm going to move this slightly over here, okay, so that we can see the candlesticks. So you can see that the S&P 500 has also bounced back up last week, the first positive week in about 5 weeks. So this is we have 4 consecutive weeks of downtrend. And then we have the first positive week last week on the S&P 500, of course, based on the US Fed news that the economy is still doing okay, and Donald Trump sort of toning down his tariff threat for the past few weeks that we have seen. So the MACD indicator has also breached the positive mark already. We have turned from negative to positive. So that means that this is a confirmation that a technical rebound is likely going to happen, and we'll likely see that the trend move upwards from here. On the RSI, we have also challenged the 30-point oversold level, so on 13th of March. And last week, we get that rebound upwards again towards the 41-point reading right now, which is also above the 14 days RSI moving average. So the momentum is coming back on the S&P 500 index as recorded by the RSI. And if we touches or breach above the 50-point neutral mark, that uptrend momentum will likely accelerate further, okay? So on the support level, we are looking at the S&P 500 cross above the 200 days moving average, now at 5,749 points. So that will be the key level to watch for this technical rebound to have some legs and sustain that upwards. And the resistance level, of course, 100 days moving average at 5,933 or the 6,000 handle would be the key level to watch right now. Okay, so we need the S&P 500 to stay above the 200 days moving average at 5,750. So we are about 100 points away from there. And then after that, once it starts to test the 5,900 level, we would need to have a closer look to see whether the momentum reading on either of the indicators shows that that momentum will likely continue. Okay, so I'll leave this marker here to see in the next few weeks whether we can get back into the zone over here. Lastly, let's move to the most volatile tech-heavy and Nasdaq Composite Index. Of course, that is the index that suffered the most pullback among the 3 US indices. And you can see that we also have a sort of a positive week on the Nasdaq Composite Index, the first one in 5 weeks. So we are looking at the 200 days moving average holding on. So that is at the 18,439 points. We are now below that at 17,700. So we still got a big gap to move up. Okay, of course, the 20 days moving average is pushing it down. So that's not a very good sign because it has been below the 200 days moving average. So we still need to wait and see to see how strong this rebound will be for the Nasdaq Composite Index. Okay, so looking at the indicators, the MACD has confirmed that we are likely to see a technical rebound on the Nasdaq Composite Index with a positive reading as of last Friday, and the RSI has been testing the 30-point oversold level for the past 2 weeks already, and after that we saw some kind of a uplift towards the 40-point level that we saw last Friday, and thereby we are now a sort of seeing momentum, rebounding momentum coming back into the Nasdaq Composite as well. So with both indicators citing that a technical rebound is likely to be in play and momentum is starting to come back on the most of the major US indices, including the Nasdaq, then definitely the first level to watch from the Nasdaq Composite Index will be the 18,400 points level. That's where the 200 days moving average is. If you are going to breach above this, likely momentum is going to build. If you get rejected here, then probably there might be more downside on the tech-heavy index for the major tech stocks. Okay, so I maintain my projection over here. Nasdaq Composite Index in the next few weeks will likely move above the 18,000 mark and test the 19,000 handle, which is the 100 days moving average that we see on the amber line here. Okay, lastly, let me move to the Singapore index. Okay, so we had a very bad week the previous week where it was down. We have a gap down of about 2%, and last week we saw a very strong rebound of 2.38% on the STI index that more or less covered the drop that we have seen in the previous few weeks. So we are back above the 3,900 points level, and we are now just about 26 points away from the all-time high that we saw somewhere in the end of February over here. So Singapore market is still doing very well, very resilient. The interest rate projection that's coming down in the second half of the year is a bit of a concern for the banks, but like what Gerald mentioned, the concerns will likely the banks will be able to mitigate these challenges, and that also brings us further good news that once the interest rate comes down, property stocks and some of the REITs may stand to gain as well. So that's a very positive news. On some of the industrial stocks in Singapore, they have also been performing quite well. So I think this rebound in the STI is likely going to get sustained. So looking at the indicators wise on the RSI, you can see that the reading at 60 is a very healthy reading, showing that the momentum that we see in the past 1 week is likely going to sustain further upwards before we test the 70-point overbought level. So we still have some legs to run, and the MACD is has been positive in the last 3 trading sessions at least. So that means that the uptrend momentum still have some legs to run, and likely we could be testing the 3,951 points level soon in the next few weeks. But then that would also be the resistance level to watch. So I'm going to trim my projection of where the STI will move towards the support at the blue line, which is the 50 days moving average at 3,862. 3,860 points, with the upside at the all-time high at 3,950. Okay, so Singapore index is doing well. despite the volatility that we see in the US and the global markets, and US index are recovering right now, clocking the first positive weeks in about close to more than a month. Okay, so things are starting to settle down, and investors should be calm right now and look out for further signs of where the market should be moving in the next few weeks. Okay, so this is what I have to share today. Gerald, anything to add?
Yeah, so I think we see continued volatility in the markets, especially in the US market.
Yes.
The Singapore market has done well in the first quarter of the year. And I think investors will be looking out for the performance of the banks, the REITs, some of the key names, ST Engineering, that's also done very well, Yangtze Shipbuilding, in the coming months. And we'll be providing updates on these names in our upcoming weekly market review as well.
Yes, so do stay tuned every Monday to our weekly market review, and Gerald and myself will always be here to update you of what's happening in the latest news that's coming out from the markets. So I think this is all the time that we have for today. So everyone trade safe and stay safe, and we'll see you again next week in the next weekly market review. Goodbye.